Thank you everybody for joining us today. My name is Reina Penalova. Most of you probably know me by now, but for those of you who don't, I am the senior analyst here in Hightower, Las Vegas. Thank you for your time today, for being here for the client briefing in the webinar format, a little bit different than the usual format, but hopefully soon we'll be able to enjoy some appetizers and wine together again. In the meantime, hopefully we can make the best of the current situation. This virtual format would allow more people to participate. Also, it is being recorded, so you'll be able to rewatch sections if you need to, or send it to your friends. And that would be a great opportunity to sign up for our YouTube channel, by the way, which has a lot more than just our current briefings on it. And Mike Pequeen is going to start first today. He's going to basically let you know what keeps us up at night. And, and Adam is going to follow up after that with the solutions that we found for the portfolios that actually allow us to have a good night's sleep after all. Thanks, and Mike, take it away.
Thanks, Reina. Yes, I will echo her welcoming comments. You know, I guess we're good at Zoom now. What keeps me up at night, I think, is the fact that my Zoom might not work. But it does seem like we are coming to the end of that period of our lives when we're going to have to do this. If this were a typical Hightower Las Vegas spring client briefing, we would have already probably had some good appetizers and a glass of wine, perhaps. So I hope that you may be availing yourself of that wherever you're at. If not, it's on us next time, probably early fall, should everything go according to plan. But thank you for joining us. And for those of you who are regular or even irregular participants of this client briefing series that we do in live or on Zoom, you know that we often talk about the economy and the markets and what's coming up in the next 6 or 12 or perhaps 18 months. And when we do that, we talk about bulls and bears, you know, the terminology of the market being a bull market being one where the stock market seems to be advancing for a sustained period, or a bear market where the market's going down for a period. And that's just the common nomenclature. Tonight's presentation is going to be a little bit different, honestly, and we'll look forward to your feedback from that. We have been paying a great deal of attention, like everybody else has, to what's going on in the economy, and we see some really important things. And we think that something bigger is afoot than what's going on in the next 6 or 12 months. So you won't really be hearing from us about bulls and bears tonight. I think we're going to, in fact, we've decided to focus on a different animal. And that animal is actually the chameleon. And the reason we're focusing on the chameleon instead of bulls and bears is because the chameleon is able to adapt quickly to both new threats and new opportunities. And we have to realize that what the globe has gone through in the last 14, 15 months or so has been obviously unprecedented. Let's use that word for the first of many times tonight. It's unprecedented. And it's left some scars, some marks on the economy. It's changed some things. And as a result, we think that there's a particularly big change that we think is starting to emerge. And we're going to focus on that tonight. And it will impact how we manage portfolios for the next several years, probably, perhaps even longer. So that's why it's a little bit different. It's about the chameleon. Okay, so let's talk a little bit first about what happened in the leading up to the shutdown. You know, this is a graph of the leading economic indicators. It's 10 different economic statistics that when you put them together, they tend to have a bit of a predictive ability. They tell you what the economy is going to do. All right, there's also the coincident indicators and the lagging indicators, but everybody cares about the leading indicators because it's sort of a crystal ball in an imperfect way. And this shows you what those LEIs, those leading economic indicators, were doing in the last several years. And you can see there in 2016, 2017, when Donald Trump was elected president and the Trump tax cut was going through Congress, that was really quite a stimulus for the economy, right? And you see the LEIs going up at quite a steep pace. But then once those tax cuts got into the economy, that was sort of a one-time thing, the stimulus from that, and then it just became the normal tax code. The economy started to slow down again. We were not going into a recession during that period, but we were definitely slowing. So going into the quarantine, the shutdown, a slowing economy was really not what you want to have. And then of course, bang, you know, it happened. Well, I can spare you all, the memories of what happened there. 13, 14 months ago, not only did our personal lives change dramatically, but the global economy, our national economy, and certainly if you're watching this in Southern Nevada, the local economy changed a great deal. So it was really, a panic in the markets. So let's go now to those leading economic indicators in another view. Here's what happened as a result of the shutdown. You can look at this leading economic indicator chart for many years back and not really see something like this. As we know, everything fell off a cliff. There was no optimism in sight, and there was only really fear and panic. So, like I would say, all hell broke loose. The bulls and the bears here are fighting it out, but at the end of the day, no one really knew what was going to happen. This was March of last year, 13 months ago exactly. And the headlines at that time were, astonishing to say the least. So one of the most interesting that we saw was almost a year ago today, oil prices, energy prices. Remember, we all stopped flying and driving, and that immediate drastic drop in energy prices was unexpected. And the producers were caught off guard, and they continued to produce oil. So they continued to pump oil into pipelines and storage tanks above ground and below ground, and oil tankers floating on the ocean. And then they were full and they were still pumping. And as a result, the price of oil dropped because the supply increased and the demand was very low. And then because they were running out of storage space, they literally started to have to pay people to take oil for a short period of time. So oil was actually negative priced. You could be paid about $37 or $38 a barrel to take possession of oil. That didn't last long, but it was clearly just something that one of those symptoms of this is not a normal time. Also, the bond market fell about 5% overall in March in one day, because people started to anticipate large corporate bankruptcies. And then the Dow Jones, look at there, it was up 2,300 points and then down, up and down over about 2,000 points over the course of 2 days. The volatility was gut-wrenching. We spoke with many of you those days. We know how it impacted everyone emotionally. Don't think for a minute it doesn't impact us emotionally as well. We just this is what we do. So we keep a brave face, but we are very, very impacted by this as well. And we were very concerned about the impact that it was going to have on many of the people that we work with. So, but look what happened. There's that steep drop in first quarter 2020, and then what we call in the technical jargon a V bottom. You can see why we call it a V bottom. The graph looks exactly like a V. It means that this sudden drastic drop ended and without hesitation started to go right back up. Sometimes there are U bottoms where it bounces around on the bottom for weeks or months before going back up, but not here. It was this remarkable turnaround. And as you know, the calendar year of 2020 was for the stock market overall quite good, despite the craziness that happened. So you can be excused if you say, what the heck? How is this happening? What possibly could do this? Particularly since that all happened when the news was still very grim. And the answer is government intervention. Government intervention in a way that we've never seen before, right? We saw the Fed slash rates to near zero, and then we saw Congress and the president start to produce bailouts. Now, in case you can't remember how many stimulus packages and bailouts there were, we produced a great chart. It started off slow, right? March 6th, let's get $8 billion out there for some R&D for the vaccine. And then the shutdowns happened about a week or 10 days later. And it was clear that massive stimulus was going to be needed and was enacted by Congress. And you may not remember that there were 6 different bills overall. The most recent, of course, was just a few weeks ago with the American Rescue Plan that was almost $2 trillion. Together, these total about $5 trillion, right? Now think back to 2008 when the financial crisis was here, and that very famous piece of legislation called the TARP bailout was produced, the Troubled Asset Program, which allowed mostly financial institutions, but also some auto manufacturers to get loans from the government so that they could not go out of business, so that General Motors and Citibank would not go out of business. That was $700 billion. That was 1/7 as much as we're talking about here. And another big difference is that the TARP were loans. Those were virtually all paid back with interest. So the government's outlay on the TARP program was very, very little. What we're looking at here is $5 trillion of complete spending in a very short period of time. Huge impact on the market. Okay, so now let's go back to the leading economic indicators. Looks a lot like that stock market chart. The fundamentals of our economy did not get better. Government stimulus is what occurred. And that's the real game changer here. That's what's different. So this is either one of my favorite charts or the one that makes me want to, I don't know, get mildly nauseous. This shows essentially those big blue and gray areas are the national debt. You know, the last time that we had a budget surplus was when President Clinton was in office, and it was a relatively short period that we had a surplus, and they weren't really large surpluses, so we didn't really pay down the national debt. But the national debt has grown a great deal and is projected to grow a great deal more. The jury's still out on what will happen here, but this is why we think it's not just an intermediate term situation. We think that this change that this situation has brought on is probably more of a generational change. They'll have lasting repercussions for 10, 15, 20, 25 years, depending on how we as a country handle it. So what's the cause of this? Well, central banks rule the roost. You know, central banks have historically helped. They've been a lender of last resort. They've been a safety net. They've been the guardian of interest rates. Here, they've literally been participants in printing money. The Fed, an agency of the federal government, has been printing money and giving it to the Treasury, essentially, to write checks. That's some crazy stuff that we hadn't seen in this scale before. And there's a cost to that. Fairy godmother is really what you want to call it. The central bankers are more important right now than economic fundamentals. And that's probably not healthy long-term, and we're not trying to scare anybody here. We don't think of this as an immediate crisis. We think of it as something longer term. And we'll talk about that in just a minute. But let's talk a little bit about some of the other things that have occurred as a result of what the Fed has done. This is the money supply. And the money supply is really what you think it is. It's all of the currency in circulation, all the coins and dollar bills and everything like that, plus all of the bank accounts, savings accounts, checking accounts, money market accounts. That's really what the money supply is. And it took us 80 years to get to $1 trillion. And it took us another 19 years to get to 2 trillion. It took us 4 years to get to that 3rd trillion, almost 5 years to get to the 4th trillion. It only took us 4 months to get to the 5th and another 7 months to get to the 6th. So when you create this kind of money, I think you know what we're going to be talking about here. So the bull and the bear have figured this out. Hopefully they're dodging what they're stepping in, but we think that the thing that they're stepping in is clearly inflation. And for many of us, inflation is a concept of something that we maybe of a certain age or our parents told us about happened in the 70s. And inflation hasn't been much of an issue for the last couple of decades. It's been averaging 2% or less. But when you start to print money at the rate we have and you increase the money supply, this chart sort of explains what happens. You can see that the dark blue line is the money supply and the gold line is inflation. And they kind of mimic each other, not perfectly, but they have a pretty high correlation. And right now, you can see that big spike at the right-hand side in the money supply, but no spike yet in inflation, right? So, this isn't a crisis. We think inflation is going to be an issue, but we think it's going to be, rather than a crisis, more of a chronic condition. It's going to be something that we have to deal with for a long time. And we're not suggesting that it's going to go to 10 or 12%. It's been under 2% for quite a while. If it goes to 3%, that doesn't sound like a lot, but that's actually a 50% increase from 2 to 3. And that has an impact on our investment strategy. So Adam will talk about that. But the velocity of money, That's the actual turnover of money. So if you cash your paycheck or deposit it in your bank, or if the government puts a stimulus check in your bank account, you have money. If you don't spend it and you save it, the velocity of money is low. But if you go out and spend it and you get your hair cut, then your hairstylist spends it on groceries or gasoline. That's velocity of money. It starts to turn over. Velocity of money is a bit like kindling in a fire. It's the sort of the accelerant to inflation, if you will. Right now, the savings rate is very high. So a lot of people have been getting stimulus checks. A lot of people have been earning paychecks and not traveling and not going out to eat. And there hasn't been a very high velocity of money. But ironically, that could be about to change. And it's ironic because if velocity picks up, it's almost certain that inflation will follow. Again, you can see this chart that it isn't perfect. But when we're talking about the trends that are going to impact your portfolios for the next 5, 10, 15 years, this kind of correlation is really very important for us. So what could make velocity pick up? Well, as I said, ironically, it could be because of the best piece of news we've had in the last year, which is the successful rollout of effective vaccines. I'm getting on a plane for the first time tomorrow in 13 months. I think a lot of other people are starting to do things like that as well. They're going back to eat, and probably by June 1st, a big chunk of the country, if not all the country, will be open without very many restrictions at all. And you'll start to see the velocity of money turn over. If we start to go into bars and restaurants and movie theaters and things like that, and we have higher occupancy levels, that's when we're going to start to see it. So that's what we're focused on. Now, to listen to the Fed, Jerome Powell, very solid thinkers, obviously, incredible scholars. They know this system in and out. They don't believe inflation's a threat. They're telling us that it's not a threat. We, however, look a little bit beyond their words because they are ultimately political appointees. We believe that inflation could be a threat in the future, and we believe it could have an impact, so we're starting to prepare for it now. So let's look at what inflation actually does to different asset classes. And you can see there where we have stocks and bonds circled. They don't like inflation. They really don't. They like low interest rates. Companies like low interest rates so they can borrow money and take on new projects at very low cost. And heaven knows bonds don't like high interest rates and high inflation. Precious metals, however, and commodities and things like real estate do like inflation. So there are always opportunities. And as Raina said, I get to lay out the problem and Adam gets to lay out the solution. So, I'm sort of Dr. Evil today, but we're aware that to some degree, inflation can be a bit like kryptonite to stocks and bonds. So what do we do about it? Well, think for a minute here. Are we all, the stock market was up last year. Are we wealthier really as a result? Or is it really just about the impact the money supply has had on the economy? When you look at the relative performance of the S&P 500, it's been great. Look at that chart. But when you compare the S&P 500 and index it to either gold, like we see here, or even to the money supply, it's not as big a gain. So eventually, you have to pay the piper. And these stock gains are funded to a good degree by, printed money that will eventually give us some inflation. So we don't want you to run out of here screaming, and we don't think you need to have an extra glass of wine because of this. But we want to make sure that we put a flag in the ground and say that this is one of the big things now that is part of our thought process, and it impacts how we invest your money, because for the last 10, 15 years, it has been a benign presence. Inflation has not been a significant threat. Now we'll have to deal with it. Okay. So clearly the Fed has been force feeding the United States economy money. That's what they've been doing. You can see here that the stock market, these are 3 different measurements of how valued or overvalued or undervalued the stock market might be. Let's look at the bottom one. That's the most well-known one, the price to earnings ratio, the PE ratio. You hear that talked about a lot. Currently, it's above its 12-month average by a remarkably large 89.8%. That's not cheap. That's not cheap. Now, we're not predicting that the stock market's going to fall. There's a lot of money in the system, and it's still going to be in the system for some time. And interest rates are going to stay relatively low for some time. But we can't help but notice this, and this really informs our decision-making process to a good degree. So this will be where I sort of end the bad news. It's a very surreal time. It's been a surreal time personally, obviously, but it's been a surreal time economically. And in the one-on-ones that we've had with each of you, that's pretty much how you've, come to understand it. What do? We've become a bit numb to what's happened. Now it's time to catch our breaths and take stock of what these changes mean and how we are going to proactively go forward so that we can have positive rates of return in the portfolios. So I'll let Adam take over and give us the ultimate solutions.
Great. Thanks, Mike. Usually, as you know, if you've been to a few of these, I'm the one that delivers the bad news. But today I get to be more about solutions, and that makes me a happy camper. So if you think about in the past, when you've had elevated stock markets and issues to have to deal with, the solution was fairly simple. You had a portfolio of stocks and bonds, and those bonds helped to offset that risk. Now, over the past 30 or 40 years or so, there's been a negative correlation between stock prices and interest rates. Stock prices and bond prices. When stocks would fall, interest rates would tend to fall as well, and that would push bond prices up. But that's not always the case. And really, for most clients that we manage money for, their investing horizon and their experience has only been in a secularly declining interest rate environment. In the early 1980s, Paul Volcker, who was the chairman of the Fed, was able to squash inflation and get interest rates moving lower. And some of you may remember having mortgages in the 13, 14, 15% neighborhood, which today just seems unfathomable. But over the past 4 or 5 decades, we've been seeing interest rates gradually move down with some intermittent spurts where interest rates have spiked. A big one was in 1994. It kind of caught the market off guard and caused a little bit of a disruption in the 90s boom that was the economic period of the internet boom and the tech bubble. But really, we haven't seen too many of those episodes over the last 20 or 30 years, and interest rates have been falling. But that's not always the case. If we were to go back into the 1940s, you'd see periods of interest rates increasing, and clearly we had interest rates increasing through the 1960s and spiking into the 1970s. So it's important to remember that interest rates don't always go down. We've benefited over the past couple of decades because interest rates have gone down, which has pushed bond prices up. So when equity markets have wobbled, we've been in a position because of the trend in interest rates to have that portfolio insurance, so to speak, in bond prices. But unfortunately, the opposite is also true. And if we get into an inflationary environment where interest rates are actually rising, that means bond prices will go down. Now, there are ways you can manage around this. The longer your bonds are to maturity, the more sensitive they will be to changes in interest rates. It's kind of like a cowboy with a whip. If you snap the whip, it's not going to move much close to your hand, which would be maturity, but 10 or 15 feet out, it's going to swing wildly. So you can manage around that to some degree, but bonds are a challenged asset class going forward because of the potential for increases in rates, and also because they just don't pay much now. The 10-year treasury has a yield of about 1.6%. It's not super compelling to put your money in a bond and lock it up for 10 years at 1.6%. Now, perhaps the inflation story doesn't materialize and bond prices continue to rise as interest rates grind closer and closer to zero, but your intuition and logic would say that can't go on forever, and eventually you would expect to see higher interest rates, especially if the velocity of money picks up, given how much money we pumped into the system. So we think that portfolios need to adapt, and they need to adapt by holding real assets in some form or fashion. Now that can be through companies that produce real assets, or it can be through direct exposure to commodities. And commodities in general are what make the economy go. They are the inputs to the final products that we use. So oil is a perfect example. It's used in the production of a lot of goods and services. If you're in the construction industry, you're seeing prices of copper and lumber shoot higher right now. Lumber's up close to 4 times from where it was at this point last year. Now, some of that is supply constraint, and it will work itself out over time. But we've seen a really dramatic rise in some commodities. Others have yet to catch up. So that begs the question of, are commodities already overvalued? And the answer is no. If you take a look at a chart we'll show you in a minute, commodities are actually quite cheap relative to the stock market. But it's really about how commodities would perform if inflation expectations were on the rise. And this chart shows that fairly clearly. The CRB index is the commodity index. The blue line is inflation expectations. And this can become a self-fulfilling prophecy. If people see prices rising, they start to change their behavior based on their belief that prices will continue to rise. That creates this cycle that causes inflation expectations to grind higher, and therefore commodity prices are likely to follow. So back to the valuation component. Well, we know that stock prices are elevated in valuation terms. Bond prices are elevated given how low interest rates are. Commodities haven't really benefited from that. Ever since the financial crisis, commodities have been in a downward spiral in relative terms to the stock market and even the bond market. And so they represent pretty good value today in relative terms to other types of investments. If the inflation story materializes just to a small degree, even to a 3 or 3.5% inflation rate, you would expect to see commodities benefit from that. And if inflation runs hotter as a result, then it could be a very positive environment for the commodity cycle. Now, gold is also in the commodity complex, and gold is also relatively cheap to stocks. Now, for most of you that have been investors with us for some time, you know that we believe that gold is an important part of almost every portfolio. Almost every single portfolio we manage has a decent allocation to gold. And that's because we view it as really a stability component of portfolio and a risk reduction component. But it also has periods where it's just one of the best asset classes to own. And that could be on the horizon. However, the last 6 to 8 months have not been so fun to be invested in gold. It had a fantastic 2020, even with the price of gold starting to roll over in the early fall, late summer. And I love this chart because if you have paid attention to your gold, you'll understand the comedy in it. But we don't believe that this pullback in gold is signaling anything other than what it's supposed to. If you thought about gold in terms of purely the money supply and nothing else, it doesn't make sense why it's not going up. But gold is impacted by a variety of different factors. One is interest rates. We've seen interest rates rise a little bit, and gold's had a bit of a challenge with that. But what matters most to gold is the real interest rate, which is the rate that you see minus the rate of inflation. And that's still deeply in negative territory. And we think we'll potentially even go more negative. But really, if you think about gold, it is a fear asset. It does well when there's fear in the system. And since August of last year, we've had a series of positive developments that have reduced fear. The election came and went. Election uncertainty is gone. The virus or the vaccine for the virus was announced in the fall, late fall last year. Now we have people getting vaccinated at a tremendous rate. Economic data has increased. Retail sales have been popping. There's a lot that's going well, and that's been a drag on the price of gold. But we don't believe that because gold isn't performing now, it's not an important part of the portfolio. In fact, it really is that lighthouse in the portfolio that provides stability and provides liquidity in times of terrible financial distress. And let's take a look at how it's performed over the past 3 or 4 or 5 decades. It's still producing about 7% annualized returns on average, but it comes in fits and starts. And because it's not doing great over the last 6 or 8 months, does not mean that it needs to exit. Gold is still a very important portfolio asset. Now, what about digital gold? I'm sure that you've seen some news about Bitcoin and the madness that has become its price movement. But what's interesting is we spent a lot of time on the subject of Bitcoin over the past couple of years, thousands of hours between us, to really understand what's going on with this digital revolution and how Bitcoin fits into it. And we are bullish Bitcoin. We believe that in the right percentage and the right sizing in a portfolio, it is a tremendous asset to own. Now, we have a completely separate presentation on Bitcoin. We've done a couple of those in the past, and we could talk to you one-on-one about it. But essentially, the reason that Bitcoin is an asset that we believe strongly in is because it has enormous asymmetry. And what I mean by asymmetry is that the downside is far less than the potential upside. If we took just a very simple example and said that because of the way that the world is digitizing and because of the millennial and the Generation Z crowd starting to gain wealth and they would prefer Bitcoin over gold, it becomes the store of value choice in the world. Well, the market for gold today is a roughly $10 trillion market. The Bitcoin market, even after this meteoric rise, is only about $1 trillion. So if it were to be the choice as a store of value, it has the potential to go up 10 times to roughly 1 times on the downside. Now, it could fall in a variety of different areas. It's a highly volatile asset, and we're not suggesting that it's going up 10 times, but it does have a tremendous amount of asymmetry. And asymmetry can be very powerful for your portfolio. So despite that it's at pretty high levels today that most people would consider crazy, we still think that asymmetry exists. Unfortunately, it's not super easy to put Bitcoin directly into portfolios, but we have found ways to get indirect exposure, and those positions have benefited from the rise of Bitcoin that we've seen over the past 2 or 3 quarters. And almost all of our portfolios have some indirect exposure to Bitcoin. There's a lot of chatter about ETFs on the horizon, and we would love to see that because we think it would be a much easier way for us to manage clients' Bitcoin exposure. But again, this is one piece of the solution set. We do believe that you have to think differently about what's going on today and what it could mean for tomorrow. And commodities, real assets, precious metals, and a small piece of Bitcoin make all the sense in the world to us. I'll leave you with this quote from Charles Darwin. It's not the strongest of the species that survives, nor the most intelligent. It is the one that is most adaptable to change. And we need to make sure that we are adaptable to change, that we are not stuck in a view because it's been a certain way for a long period of time, that it will continue to be that way. We need to be forward thinking. We need to take the data into consideration. And we don't know if the inflation story is going to materialize today or tomorrow, but we have high conviction that it will materialize at some point, and being prepared for that is super important.
Very good. Thank you guys for joining us. We look forward to buying you at least a cocktail or a beverage of your choice and some great appetizers next time when we can see you in person.